Welcome to Exchange Traded Fridays, brought to you by ETF.com. I'm your host, Paul Curcio, managing editor of ETF.com. Joining me is ETF.com's crack team of writers and editors, senior ETF analyst Sumit Roy, senior content editor Kent Thune, and contributing editor Ron Day. We'll also have a special guest later in the episode. As usual, in the meantime, we have a lot to cover, so let's dive right in. This week saw interesting developments that affected the ETF space. First was the Fed revealing its decision on rates. Second, the markets officially recovered from the Liberation Day slump a month ago. And a giant in the investing world, Warren Buffett, announced his retirement. So let's start with the Fed. That's the big news. That's what's been on everyone's mind. Kent, you wrote the market reaction story on Wednesday after the news that there would be no rate cut this time around. More interesting, you looked at the Fed chair, Jay Powell's news conference, and you were searching for hints of what's to come for ETFs. What did you find out?
Well, more of the same, which is not bad news, which is also why the bond market at least somewhat embraced it. One of the main ETFs that we track, the iShares 20-year plus Treasury ETF, TLT, rose that day over half of a percent, which is not a bad little bump for a bond ETF. And what they were reacting to was Jay Powell and even the minutes of the Fed reiterated the same stance, which is interesting. And it's a kind of a balance, or maybe you call it a threading the needle type of a thing that the Fed has to do. And they stated, quote, the FOMC judges that the risks of higher unemployment and higher inflation have risen. Okay, so really that just translates into what we may call stagflation. I mean, so we have this risk of higher inflation, but also from tariffs, but also higher unemployment. And so it's just kind of a wait and see. So that the odds of a rate cut or probability for June have fallen below 50%. So it looks like the next rate cut might not come until July. And so that's the Fed reaction, which is not terrible. It's not terrible news, but it's also just kind of more wait and see is what it is.
And where in the ETF space are we finding these actions or inactions by the Fed at this time?
Going back to TLT, that's one of the more rate sensitive ETFs. Mm-hmm. So, and we also see a lot of flows. I know Ron's been writing on this, huge inflows in SGov, which is the ultra short. So if you're looking at the whole spectrum of duration, ultra short is more popular just because, okay, I'm not going to lose money with this. It's a cash equivalent. I can get a decent yield over 4% while I'm waiting for the chaos to subside. But then you've got TLT, which if rates do fall, the price is going to rise more with that because of its rate sensitivity. So you've got people who are maybe kind of betting a little bit that this thing could end with a recession. So you've got all these different tools to use. I mean, maybe some people have a little bit shares of a little bit of both. But yeah, you're going to see TLT react more to news, and you're going to see more of the heavy flows in SGov because of people seeking more safety.
So speaking of safety, two of the places that people have been going lately, the traditional safe haven of gold and the more recent quasi safe haven of crypto, have been making a lot of news lately. Sumit, you made an observation about, and you used through using our data tools, that the gold ETF, GLD, is winning the performance rate, but the Bitcoin ETF, IBIT or IBIT, is on top when it comes to flows. Why is that?
Yeah, it's interesting, Paul. If you look at the performance data, GLD is up something like 28%, which is sharply higher than the 7.5% return for IBIT, the largest Bitcoin ETF. That gap has been narrowing a bit as we've seen Bitcoin recover in the last few days and weeks, but we're talking about a 20 percentage point spread between the performance of gold and Bitcoin this year. Yet, if you look at the flows data, you see something entirely different. IBIT is actually leading GLD when it comes to inflows this year. So far in 2025, we've seen IBIT collect around $7 billion of new money, whereas GLD has seen inflows of around $6.3 billion. So pretty neck and neck, but IBIT is ahead of GLD. And I found that a little bit interesting, right? Because you're getting this tremendous rally in gold, 27% on top of a similar return last year. Yet the inflows into this product haven't been all that huge, and they are still less than what you're seeing in IBIT. But I also said that, you have to zoom out and take the whole category as a whole, right? These are the two flagship funds in the respective categories. But if you look at gold ETFs as a whole, they've collected around $15 billion. And then if you look at Bitcoin ETFs as a whole, they've collected around $5 billion. So different story if you look at the entire category versus just one fund. But it's still kind of interesting, right, that IBIT is beating GLD this year. Another thing I should mention, Bitcoin ETFs, it's very US centric. The US Bitcoin ETFs, they dominate the market. There's not much in terms of inflows when you look overseas. Those Bitcoin ETFs are much smaller. But for gold, it's actually not the case. Gold ETFs are enormous worldwide. And in fact, I talked about how there's been $15 billion of inflows into gold ETFs in total in the US. If you look globally, $55 billion of inflows into gold ETFs. So we're seeing larger inflows outside of the US than we are in the US, which is interesting as well.
One thing I would add to that, Sumit, is on everyone is that, just looking at performance over the last month, and I was like, oh, wow, I just realized it's been exactly 1 month since the market nearly reached that 20% correction level, 18.9 or whatever it ended up being. So April 8th is where that bottom was. And now, as everyone is listening, it's a little bit after April 8th, but we're looking at the last month. Bitcoin, by far, as far as the radar I look at, all different types of benchmarks, is the big winner over the last month. Over 25% gain,
Yeah.
and that more than doubles gold's gain. And of course, it's better than equities and everything. So it's an interesting story. If we're buying on these extreme dips, at least in the current environment, maybe Bitcoin is the asset to buy.
Yeah. That's a great point, Ken. These are two very different assets, right? If things are falling apart and, the world is just completely, in this state of uncertainty, then gold tends to do better, right? But when things are going well, then Bitcoin starts to outperform. We've seen this interesting dynamic. They're both considered safe havens, but they're very, very different assets. They do not move in tandem, not even close. And that ultimately comes down to the drivers of demand, right? If you look at gold, the market is pretty diversified, but there's a big segment of central bank buyers in there. You have people buying jewelry, and then you have people buying physical coins and bars. That's pretty big market in China and India. And then, of course, you have the ETFs as well. On the other hand, in Bitcoin, you don't have central bank buyers, of course. You have a lot of speculative money, things like that. And then we have these new ETFs. So very different demand drivers when it comes to these two assets. Gold is a much older asset. It's been around for thousands of years, established demand, and supply tends to rise, 1 to 2% per year pretty predictably. Bitcoin, different supply story as well. Eventually, we're going to head to that 21 million coins, and then it's going to top out. So, yeah, I mean, you got to keep that in mind. That gold and Bitcoin, they get tossed around as safe havens, but they're completely different assets.
Sumit, I want to revisit something you were from earlier, because you were talking heavily about inflows. So for the benefit of new listeners, people who are new to ETFs, who are discovering our podcast for the first time, can you explain a little bit it's a learning moment here, a teaching moment, let's say, a little bit more about why the inflows are important, how they differentiate for these new investors, how they differentiate from, say, from price movement and the value of investing in ETFs.
Yeah, I think the most simple way to understand it is inflows represent the demand for an ETF, but it doesn't necessarily represent demand for the underlying asset. So you could see a fund getting bigger, people putting money into a fund, but the underlying holdings of that fund could be either going up, they could be going down. It doesn't necessarily tell you what's going on with the underlying holdings. So sometimes you could see, for instance, a fund is growing, people are putting money into the fund, but the stocks within that fund are going down. So you might see kind of a disconnect there, and that might confuse people a little bit. You're seeing inflows, but you're seeing the price of the fund going down. That essentially comes down to the fact that ETFs just represent one segment of buyers, right? You have the ETF investor, but there's individual stock investors as well, and they're doing their own thing. So ETFs are a growing part of financial markets, but they don't represent the entire financial market. There's an entire, ecosystem of mutual funds, individual stocks that people hold, things like that. So yeah, the flows are an important, I think, indicator of what the ETF investor is thinking, but the ETF investor might be thinking a little bit differently than other investors who aren't using ETFs.
And speaking of someone who thinks of investing differently, but whose way of thinking about investing has influenced generations of investors, last weekend was Berkshire Hathaway's much anticipated annual shareholders meeting, where the Oracle of Omaha himself, Warren Buffett, announced that he'd be retiring at the end of this year and hand over the reins to Greg Abel, one of his able lieutenants, who's actually been quite active already in running of Berkshire Hathaway. Obviously, the Class B shares are accessible to most investors, but Ron, you wrote about the shareholders meeting earlier this week. What are the copycat ETFs that have popped up that attempt to emulate Buffett's returns, and how can ETF investors work with those for their own portfolios?
You like a little irony is that Buffett had said to be careful of, kind of like gimmicky things. He used the word specialty in one of the comments that we used. When his will says that 90% of the money left to his widow should go into an S&P 500 index fund. And he said, try not to pick specialty ETFs on index funds or over index funds. But the funny thing is that we do have these ETFs that are aiming to mimic Buffett's style, and they're all charging high fees. I shouldn't say all of them. The ones that, so I'm looking at this one, OMAH, that came out just a couple of weeks ago. The Vista Shares Target 15 Berkshire blah blah Select Income ETF. Long title. It's nearly a 1% management fee. And Buffett was saying, stay with the S&P index funds, which, I think he had been in SPY and VU, which are some of the lowest load ETFs around. This other one that people are following his ideas, except for on the fees. So, but at the same time, this OMAH has performed very well compared with another one that launched last year. Excuse me, LIVR. LIVR, actually, I think that was 23, has only pulled in 16 million in AUM. OMAH has pulled in like 140 million in like a month and a half, and it's really gone through the roof. It's performed very, very nicely. Also the Buffett style ETFs are also, or the Buffett kind of mimicking ETFs. There's also one that was launched in London, the Buffettique Growth Strategy ETP with the ticker BUFF is on the market for our listeners overseas. But, as we know, Buffett loved investing in ETFs, a big holder of SPY and VU, even though in the last quarter of 24, their 13Fs showed that he had no more ETFs. Yeah.
Because you can't take it with you, Ron. He's
I
been
think
cashing out.
I think he imagines he can because he was moving to cash. So
He's been cashing out for a while now.
Yeah.
I think you also raised something really interesting about his advice to his wife to be 90% in index funds and 10% in short-term bonds. But in short-term bonds ETFs, like the ones Kent was referring to earlier, SGov, right? And I think it's been mentioned that Buffett was in SGov, has been in SGov as well,
Yes.
as opposed to just buying treasuries flat out. It's actually very convenient. Although the difference is there is the load that you have to pay with the ETF versus just going directly through Treasury Direct. So there's that.
Yeah.
Let's switch gears now and welcome a special guest to today's episode. He's the co-founder and managing partner of Neos Investments, as well as a portfolio manager of the firm's exchange-traded funds, Garrett Paolella. Welcome, Garrett.
Hey, Paul. Thanks for having me on today.
It's a pleasure to have you this episode. So give us a brief overview of your background. Tell us a little bit about what Neos does and what you do for Neos.
Sure. So I've spent my career in the asset management space, really focusing on utilizing option-based strategies for ways to derive tax-efficient monthly income, risk mitigation through ETFs and investment solutions. Here at Neos, that's exactly what we focus on. Neos actually stands for Next Evolution Option Strategies, and we're really looking to allow investors to espouse their market views, risk tolerances, or income needs in really tax-efficient income ways. And so we're producing, we have over 11 ETFs as of today, where clients can choose across different asset classes, risk exposures, really to derive that high tax-efficient monthly income.
So you have 11 ETFs now. Anything interesting in the works that you could share with us?
Always some things in the works. The closest one that's actually filed for and probably coming out in the next month is going to be a gold high income. So leveraging, some of the volatility levels on gold, obviously after this recent run, for clients that are looking to, generate some income off an asset class that has historically not paid, an income.
And how are investors using these types of strategies that you're providing with these ETFs in their portfolios? What have you seen directly in your experience as the manager?
Yeah, so I think we've developed these products to fit basically where those existing asset classes already are today. So when you think about our, SPYI or QQQI, two of our equity high income products, that's going to fit within that equity allocation where you might have either just long only equity exposure, equity dividend paying, stocks or ETFs. And then we kind of cascade that across the other asset classes. So we have products across the entire fixed income curve. We have products within alternatives such as real estate and Bitcoin. And so the concept really is that these products should fit within where those existing allocations already are in ways to enhance, your tax efficient income for the portfolio and also mitigate some of the volatility and risks with just being in that long only or vanilla based product.
So that leads to an interesting question. So how can an options-based strategy harness some of the recent market volatility that we've been seeing to help clients generate income?
Yeah, so volatility is a great asset class to actually generate income. So the higher the volatility, the easier it is to generate income through selling options, right? You don't want to be a buyer of options in those timeframes. You actually want to be a seller of them. And so as we see volatility go higher and equity markets coming in lower, you can generate higher amounts of income to clients' portfolios and those investment strategies. And so I think what we talk to a lot of investors about is don't make volatility, right, a concern in your portfolio. Actually use it to your advantage to generate income and have it as an opportunity to produce returns, and income for those portfolios.
So is that income tax efficient? And if it is, why is that?
So this is a big topic of conversation nowadays because you've seen over 600 ETFs in the option-based category now. If you think about myself and my co-founding partner, Troy, we were the ones that brought the very first option-based ETFs out well over a decade ago. And so as you think about the products you're looking at, certain ones such as ours, which is where we really focus our core investment process around, is being tax efficient. And so we do that in a variety of ways, mixing not only using index options, which gets a much preferential tax treatment over, say, an equity option or a swap or an equity linked note, but also we embed tax management and tax efficiency strategies within our actual investment process. So where we can, we tax loss harvest. So I think any investor that's really looking to make an income allocation should really be thinking about how that net after tax return really looks relative to the gross return that the investor is taking. So yes, they can be tax efficient. That's really a big piece, Paul, of like what we focus on here, within our products, is how to make sure that that's delivering the best tax efficient outcome for investors.
So now let me ask you to put on your prognosticator's cap. Okay. It's been an interesting year so far in the markets. What's your outlook for the rest of the year? What are you seeing?
So listen, I still think we came into this year with an outlook of volatility being higher. I think as we looked at the last 4 years of the Trump administration, his first time in office, right? You saw volatility shocks. You saw a lot of social media posts. We expected that coming in. Not entirely surprised about what we saw with the tariffs. I think that continues. I think there's always going to be a shakeup coming from this administration on trying to make big structural changes, right, based on their opinions. And so I think what's most important for investors is really to know what your risk tolerance is and invest towards that. So if you're stretching out on the risk curve, whether that be equities, overweight or something along those lines, just know that there could be very much events that could happen within your portfolio. So of course, coming back to what we do, we're always playing to help manage that volatility, manage smoothing out that income source, that return stream over a period of time. But I could certainly see still bigger bouts of volatility. I think we do get some rate cuts. Obviously, what we're hearing yesterday is that could be later in the year. But I also think there's a big tit for tat of who's the one in charge between Trump and Powell. So ultimately, once hopefully those two get it solved, everything's going to be back focused on really driving, the economy and what the data, is pointing to.
I couldn't agree more. It sounds like a solid outlook. So thank you so much, Garrett, for joining us today on Exchange Traded Fridays. And we'd love to have you back anytime.
Appreciate being here and thanks for the opportunity.
Thanks to all our listeners for streaming or downloading Exchange Traded Fridays. Remember, if you haven't already, please like, subscribe, or follow us wherever you get your podcasts. And if you have a question or just want to share your thoughts, join the conversation with us on X, formerly known as Twitter, where our handle is @ETFCOM. See you next Friday.